title. And it's saying that legal title goes to deal when deal sells the car on to a customer. But from an accounting point of view under IFRS, we actually don't care about that. It's not relevant. So effectively we ignore it. What we do is we look at this stuff. So who has taken on the risk and the rewards of inventory? Well, with inventory, one of the rewards I get from inventory is that I can sell it and I make a big profit. Okay, and if market prices go up, then the amount of profit I make goes up. One of the risks, therefore, is if the market prices go down, then I bear the risk of having smaller amounts of profit. So when we start looking at this price that deal is paying is fixed at the date the car is delivered, then any risk and reward of a fluctuating market is going to be borne by deal. Okay? So deal is basically bearing the risks and rewards in that case. The car cannot be returned to man. Well, if the car can't be returned to man, then that clearly is that deal bears the risk of obsolescence, of never being able to sell this car. So that looks like it's deal. Okay? And the third one, man is charging interest on the value of inventory held by deal. Well, again, if it means that the longer it takes deal to sell it, the more it costs deal, then that implies that deal again takes on the risks and rewards. So when we start looking then at how to establish the substance of this transaction, well, we ignore the actual thing about at what point legal title actually changes hands, and what we look at is these terms in the contract which indicate the substance. What is the economic reality? In reality, this car effectively belongs to deal at the point that it's delivered. So, with the price being fixed, with the car not being able to be returned, and an interest charge, it basically means that the car is included in deal's inventory from the delivery date. The flip side of that, of course, is therefore that man is recognising the revenue. Okay, so the car is included within deal's inventory from the delivery date. Therefore, man is able to say we have transferred the risks and rewards of ownership of this car to deal. So therefore, man can recognise the revenue, even though legally they still own the car. Okay, the clauses within the contract means that in reality, the economic substance of the situation is that deal actually owns the car. Okay. Even though legal title, and if it went to the courts would say this car is the property of man until legal title is transferred. We'd ignore all of that and we'd say, yeah, but the substance of this transaction is very much that that car actually sort of belongs to deal. So therefore, man would recognise the revenue at that point. Okay? Excellent. So that's the first of our 5 criteria. The other ones are a little bit more straightforward. Okay, so the second one, the seller no longer has management involvement or effective control over the goods. Well, let's say, for example, I was a brandy distillery. Okay, so I'm producing brandy and I'm selling it to my customers. Well, let's say, for example, I decided to sell some of my brandy to the bank. Okay, now this particular brandy is only drinkable when it's 7 years old. Okay, and so therefore I can only really sell 7-year-old brandy. However, I sell some 4-year-old brandy to the bank. Okay, now in reality, do you think that the bank is actually going to take delivery of that brandy? Probably not. In reality, the brandy will almost certainly stay in my distillery because I know how to store it, I know how to keep it, I know how to age it properly. So in reality, I'm still retaining management involvement or control over the goods. So even though technically the bank owns the sort of the brandy, and they've probably come around with a little brass plaque and they've just nailed it in and put a little brass plaque. Let's just hope they've used very short nails, but if they put little nails on the actual barrels, then technically they own it, but the substance of the transaction is that I haven't really given up management control. I still decide exactly what happens to those individual barrels, in which case we would not recognise it as revenue. Even though there's a sales invoice, even though all the paperwork is in place and bankers and lawyers have been involved with it, we would basically ignore the fact that sales happened and we'd say, yeah, but in substance, it's still my brandy. Okay? Cool. The third one, the amount of revenue can be measured reliably. Well, let's face it, guys, if we're talking about doing some debits and credits, we need a number to put in there. So if I can't measure the revenue reliably, then therefore the answer is you don't recognise revenue. So you have to be able to establish what the actual level of revenue is. The fourth one, it is probable that payment for the goods will be received by the entity. The effect of this is that revenue in relation to credit sales is recognised before payment. This is just a simple application of the accruals process. Okay, you wouldn't sell some goods to somebody if you didn't think they were going to pay you. We accept that it's almost inevitable that some of those people might not pay you. The difference being is, did you kind of know that beforehand? Well, if you knew it beforehand, you wouldn't have sold them the goods. So that one's kind of an automatic tick, really, because you wouldn't have sold them the goods in the first place. And then finally, the costs incurred, or to be incurred, again can be reliably measured. Now, this is something to watch out for when you're doing your assessment, because this is a little trick question that sometimes throws itself up. Okay? It doesn't matter if the costs are zero. What matters is that we know that the costs are zero. Okay? So when it says that costs can be reliably measured, it doesn't actually mean that there has to be a cost. It just means that we can establish that the cost can actually be sort of accurately arrived at and would be 0 or 50 or 500. It doesn't actually matter what that number is as long as we know that number reliably. The reason for that is if we don't know exactly what that number is going to be, then we'll be unsure as to what level of profit there would be in the transaction. And if we don't know what level of profit there is in the transaction, then the rule is that we can't recognise any profit in the transaction. And so revenue is limited to the recoverable costs. Okay? So let's have a quick look at that. Let's say, for example, that I am going to provide a service. So even though we're talking about sale of goods, this works as well in sort of provision of service. Okay? So I'm going to provide a service. And under the contract, part of the problem is, though, is I don't actually know how much it's going to cost me to maintain this fleet of vehicles. Yes, there'll be the odd little bit of scheduled maintenance, like a service or something like that. But, you know, let's say one of these trucks breaks down. Well, I don't know how much it's going to cost me to actually fulfill my side of the obligation. My costs are uncertain. Now, if my costs are uncertain, what I need to do is I need to think about when I'm going to recognise that 5,000. Okay, so when do I recognise the revenue when my costs are uncertain? Well, the simple answer is I can't. I can only recognise my revenue to equal my recoverable costs, which is usually my costs incurred. And I would recognise my costs incurred as revenue, so in other words, zero profit, up until the point where I can say, actually, I do know how much the cost is going to be. So if this was a 1-month contract, in the first week, for example, I probably wouldn't know how much my costs are going to be. In the second week, though, I'll know what my costs were for the first week, and if for the second week they're about the same, I might be able to turn around and say, well, actually, it seems to be that the costs are going to be the same every single week. And if the costs are the same every week, then I can say the costs I'm going to incur on this contract are, say, 2,000. Therefore, I know what my profit's going to be, in which case I would recognise my revenue on a weekly basis. Okay? So you restrict the amount of revenue that you recognise to be the same as the recoverable costs until the point arises where you can more accurately sort of say what the total costs are going to be, and at that point you would recognise the revenue in the way that we're going to see next, which is to do with the actual provision of services. Okay, so those are the 5 criteria for the sale of goods. What we now need to do is we need to look at the provision of services. Okay. Now, the provision of services, there is still a criteria on provision of services. So if you just flip over to page 64, okay, you'll see that at the bottom of the page there it starts talking about the rendering of services. Now, if we think about our 5 criteria that were there for the sale of goods, okay, what happens is those criteria change slightly. Okay. So, with the sale of goods, we had the 5 criteria. Okay. One, disappears. 2, disappears. Okay? So we get rid of the transfer of risks and rewards. If I'm providing a service, so for example, we're providing, as the ICAW, we're providing a service by delivering this training, I'm not really transferring risks and rewards of ownership. You know, you don't now actually own my brain. Okay? Granted, you get the DVD version available in the recording of it, but you don't actually have any title or any real responsibility for me. Okay? So risk and rewards is no longer valid. Likewise, management control. Well, in a situation like we have here, there is really no management control that is transferred or retained, because it's the provision of a service. Once I've provided the service, I've provided it. So those first 2 aren't relevant. The third one is still relevant. We have to be able to measure that revenue reliably. The fourth one is still relevant. We have to be able to ensure there's probable benefit. So for example, if I don't think my customer's ever going to pay me, then I wouldn't recognise revenue. And the fifth one is also sort of more important. And as we saw in that earlier example, this one is actually probably now one of the most significant. Because whenever you're providing a service, it may be quite difficult to establish the level of costs that are actually sort of being incurred. Okay. In addition to that, we now bring in another one. The extra criteria that we need is that the degree of completion can be reliably measured. So what we're saying is, what am I actually doing in return for this revenue? So if I'm providing you with a service for a period of a year, logic would say my degree of completion is on a monthly basis. So I should be able to recognise 1/12 of the revenue per month over the year. And under most circumstances, that would be the most appropriate way to do it. So you would recognise the revenue on completion of whatever you're contractually obligated to provide as that service. So if it's a 3-year software maintenance contract, it may well be you recognise the revenue on over the 3 years of the actual contract. The problem arises when it doesn't actually happen on a sort of a monthly basis. So let's say, for example, you go and buy sort of some opera tickets, okay, and you buy a season ticket for the opera, okay. Now, the season ticket for the opera, and like I say, you all look like you would be avid opera fans, so I'll use opera as an example. So you are going to the opera, okay, and this season ticket entitles you to attend 10 shows, okay, and in January there is 1 show, in February there is 1 show, in March there are no shows at all, in April there are no shows at all, okay, And in May, there are no shows at all. That time of the year, not good for the opera by all accounts. Okay. In June, there is one show. In July, there are 2 shows. In August, there is 1 show. In September, you have 3 shows. And in December, so there's no shows at all in October and November, and in December you have your 1 show as well. Well, even though this season ticket is entitling me to watch 10 shows from the period of January to December, I'm hoping that you're all looking at those figures and realising that you shouldn't really recognise 1/12 of the revenue from season ticket sales on a monthly basis. For example, there are no shows in March, April, May, and there are also no shows in October and November. So it would be inappropriate for me to recognise any revenue during those 5 months for the simple reason that I haven't done anything to earn any revenue. Likewise, when we get into July and September, it only seems fair that I should recognise more revenue in those months because I'm actually doing more to try and earn that revenue. And that's the rule. So we recognise the revenue as we fulfil our contractual obligations. So when we quite glibly say that the degree of completion can be reliably measured, what we're actually looking for is that we can understand what level of contractual service we are actually having to provide in order to receive that revenue. Okay. And finally, if that's our first 2 sources of revenue, the third source of revenue, which was other, which we said is kind of like revenue arising from so like the return on assets. Okay, this would be, as we said, interest, royalties and dividends. You account for these on an accruals basis. So for interest received, you would account for that when you become entitled to receive that interest. On royalties received, again, you would account for that as revenue when you are entitled to the royalties. Remember, it doesn't matter when the cash flows arise. What matters is at the point at which you are entitled to receive it. And dividends, again, you can recognise dividend income at the same point in time when the company you've invested in that's paying those dividends is actually able to recognise the dividend expense. Now, under IAS 10, which is one of those subjects for home study, you have dividends, and you can only account for a dividend at the point where it is actually declared. So proposed dividends and dividend liabilities effectively don't exist anymore. So you're only accounting for a dividend at the point where it is declared, which is usually when it's either paid or alternatively when it's agreed by the shareholders at an AGM. So for dividends, you can only account for the dividend income once it is declared by the company that you're holding those shares in. Okay? Excellent. So that's recognition of revenue. The disclosure requirements on revenue is that you are required to disclose the revenue. We're not talking at this stage about reportable segments and kind of like segment reporting regulations. So you would literally have to put a single statement in your accounting policies to identify at what point you are recognising the revenue from that. Okay, now this brings us on to kind of like applications and examples. And if you just have a look at page 66, what we've done is we've put into the notes for you a couple of the specific examples that I've already mentioned out of the appendix to the full standard. And these are the more common ones. Okay, so first of all, consignment sales. With consignment sales, the buyer's taken delivery of the goods and undertakes to sell them on behalf of the original seller. Okay. Although the buyer's taken delivery, as we've seen already with a car dealership, is that they potentially could return them to the original seller. Okay. So if you look at illustration 4, please, in the middle of page 66. Okay. An entity sells recorded music from emerging artists through a number of retail outlets. The outlets can return any unsold material within 3 months of receipt. The artists are unproven in the commercial market, and it's unclear if the sale of the music will be successful. Uncertainty about the timing of receipts from retailers. This uncertainty is only removed when the retailer sells the music or the 3-month period has expired. The risks and rewards of ownership do not pass until the retailer has sold the music. Okay? So in this situation here, what we're saying is because these artists are unproven, there's no real established market, revenue can't be measured reliably, so therefore they shouldn't recognise revenue, okay, until their customer sells on to the third party. Okay? So revenue should be recognised at the end of the 3-month return period or when the retailer has sold the music if earlier. So because there is a sale or return period of 3 months, there is no revenue being recognised sort of by the entity doing the sale until that 3-month period has expired, because the purchaser could return those goods any time within those 3 months or at the end of the 3 months. So again, it comes down to substance. At what point does the risk and reward of ownership actually transfer over to the customer? Well, it only transfers when they are at the end of that 3-month period. Okay. Subscriptions to publications. Again, if you have subscriptions to a publication, you can only recognise the revenue from that subscription income as the publications are produced. Now, if that is on a monthly basis, you would recognise it on a monthly basis. If it's on a quarterly basis, you'd recognise revenue on a quarterly basis. If, however, these publications carry themselves different values, so for example, your December edition, your Christmas edition, is twice as thick and includes twice as much information and normally retails at a higher price, then you would proportion your revenue accordingly. And you'd recognise more revenue for the December issue than you would for the other issues. Servicing fee included in the price of the products is one we've already seen, where you would need to ask yourself the question of do we need to bundle it or unbundle it. And in most cases with these service agreements, as you can see in illustration 5 at the top of the next page, page 67, you can see there that they are suggesting that we go down the route of sort of the after sales being deferred. Okay? Now in most cases when you're dealing with sort of the sale of goods and an embedded kind of service element, you would normally be required to separate them out. Okay? Advertising commissions. If you are an advertising company, you would recognise revenue from your customers as the adverts that you are producing for them are distributed to the public. For franchise fees, any fees which are required from the franchisor are spread over the life of the franchise, okay, as the services are provided. And for agency transactions, if you are an agent, so you buy from one company and then just sell it on to another, then the question is, do you recognise gross income and gross costs? Well, the answer quite simply is no. If you are purely an agent, the only revenue you recognise comes from the commissions that you are entitled to. So every time you make a sale, rather than recognising the full revenue and the costs from your supplier, you would just say, we earn 5 currency units worth of revenue, we only recognise 5 currency units. Now, there's 2 extensions to this that we just need to be aware of. SIC 31. Now, an SIC is Standing Interpretations Committee, and they tend to deal with just those areas of confusion, and they're just clarifications. They fairly recently changed the name from SIC to IFRIC, IFRIC, but they're basically the same thing. IFRICs are just newer versions. So, SIC 31 barter transactions. From the sort of commencement really of the .com industry, a lot of people were boosting the value of their .com by placing adverts and receiving adverts from their friends. So if I, for example, set up a website and one of you set up a website, we could have a conversation whereby I advertise your site on my page and you advertise my site on your page. Well, no cash is changing hands. However, we could say, well, tell you what, I'll pay you $10,000 US for you to advertise my site, and you pay me $10,000 for me to advertise yours. In the grand scheme of things, there's no cash changing hands. And a lot of .coms use that method to boost their revenue earning potential and therefore increase the values of their business. Well, SIC 31 came around and said, hang on a second, you're not allowed to do that. So you cannot artificially inflate revenues and costs when you have a barter transaction. So you do this for me, I'll do that for you. If the value of it is roughly the same, you don't recognise any revenue from that transaction. You then get a particularly fun one, especially if you're an airline, okay, which is IFRIC 13 over on page number 68. Under IFRIC 13, what it's effectively saying is, that if you offer a customer loyalty scheme, how do we record the revenue? So let's say I fly with Emirates Airline, for example. So I fly with Emirates Airline and I get my little card swiped when I check in, and it adds 5,000 miles to my loyalty scheme. And at any point in 3 months' time, I can use those 5,000 miles to give myself free flights. Well, the question is, how does Emirates recognise their revenue from selling me the flight that I've just taken, and what do they do about the free flight that I'm going to get in the future? The answer has been clarified. There used to be two different approaches, and those two different approaches cause themselves, obviously, a lack of comparability. So under the two approaches, the first approach was that you would recognise the full revenue for the flight that I'm actually taking, and you would then recognise a provision for the free flight. So if I've paid $2,000 to fly from, let's say, London Heathrow to Dubai, okay, they would recognise the full $5,000, okay, and they would recognise a provision for, say, $500 for the free flight that I would be entitled to in 3 months' time. The second option, okay, this would be where they would split the revenue into revenue from the flight I'm taking and deferred income relating to the flight that I will be taking in 3 months. So the $5,000 that they are receiving, they would actually recognise $4,500 as revenue now, and they would show the $500 as deferred income. Now, this IFRIC actually clarifies and says that you are not allowed to do that. Okay? So IFRIC 13 says that you must only use this splitting of revenue and recognise it as deferred income. Okay? And this is applicable, IFRIC 13 comes into force on the 1st of July 2008. Okay? So IFRIC 13 comes into force on the 1st of July 2008. So it's a fairly recent standard, and it's going to cause a few difficulties, especially for airlines, and potentially also for certain retailers that provide customer loyalty schemes as well. Okay, now that brings us to the end of the chapter on revenue recognition. So just to summarise, what we're saying so far then is revenue comes from three main sources. The first source, this is from the sale of goods. The second source, this is from the provision of services. And the third source, this comes from sort of other, which is the return that you're generating from various assets. Okay? The criteria for sale of goods, we have 5 different sort of things to look for. Transfer of risk and rewards, which I suspect you may have some questions on, because it's again about substance over form. We have the management control, again an indicator of substance over form. We have revenue reliably measured, probable economic benefit, and costs being reliably measured. For the provision of services, we drop the first two, okay, the risk and rewards and the management control, okay, and we retain the other 3, and we add to it that the degree of completion has to be sort of able to be established. For the other, we recognise it effectively on an accruals basis. Okay, well that brings us to the end of this chapter, sort of on revenue recognition. So once again, for kind of like 5 minutes, just like to open up to any questions from sort of any of the different locations. So has anybody got any questions, please?
I have a question about the transitional provision for this FIC or IFRIC. Is it
Yep.
I think that there is some specific transitional provisions, but in general, are they applied on retrospective basis or prospective basis?
The provisions that you're making for, so it's done on a prospective basis, so you wouldn't need to go back and start splitting revenue from years before. It's a very good question, actually. Just for those of you who didn't hear, the question was, with the sort of IFRIC 13, from implementation, do you have to backdate it and account for revenue previously under the IFRIC, or can you just deal with it prospectively? It is a prospective select standard. You can, if you want to, you can choose to adopt it retrospectively, but there are specific transition rules within it. The reason being is it's a clarification of the rules rather than a specifically new standard as such. So therefore you can just adopt it going forward. But many companies that I've been dealing with and been talking to, a lot of those are actually looking at adopting it retrospectively, certainly for the purposes of their comparative information, just to give themselves so like, you know, the actual sort of comparability year on year. Any other questions, please?
Okay, I have questions. Last year, the IASB has issued a IFRIC D21 on revenue recognition for real estate developers. So my question is, what is the treatment on this D21, and is it okay for us to adopt, early adopt this D21 in our work?
It is allowable to adopt sort of like draft IFRICs. If I had to put up my kind of like, you know, sort of my arm on the line, as it were, I would say that it's never a sensible thing to adopt a draft IFRIC, for the simple reason being is the process of an IFRIC coming in is it's open to late changes. And so if you adopt a draft IFRIC very early, sometimes you can find that the final version that comes out is slightly different, and it can cause a different accounting treatment. So whenever you have a draft IFRIC, like D21, I would be very tempted not to actually adopt it early and to actually wait until it becomes a full standard or a full interpretation. Like I say, there has been a number of it. I mean, even this one, for example, with IFRIC 13, in the initial draft, they actually were suggesting the alternative of recognising a provision. And when it came through into the final IFRIC, they'd actually changed their mind and they recognised their thing. So adopting draft IFRIC sometimes is a little bit risky.
Yeah, but do you have any idea on the update on this draft IFRIC?
As far as I'm aware, yeah, the implementation date. How long's a piece of string, unfortunately, is the answer there. I would anticipate it'll be sometime within the next 2 to 3 months, but it'll have an implementation date, I would imagine, of 2009. So whenever it gets finalised, I would imagine that the implementation date will be sort of mid-2009. But please bear in mind, I'm kind of guessing at that, because obviously nobody knows sort of how quickly the IASB is actually going to get these things out. But certainly the timings of it would normally anticipate that it's going to be implementable about 2009.
Okay, thank you.
My pleasure. Any other questions, please?
This is about the barter transactions. I just wanted to clarify, you said a while ago that if the value between the parties involved in the barter would be of somewhat same, then this would be ignored. Is there a need to disclose such kind of transaction happening between these two parties?
Yeah, the standard itself is fairly quiet. I mean, I would imagine that sort of an entity would want to disclose information on that, because effectively you are providing a service for somebody else. But the standard just says that it's not revenue, so therefore you're not having to disclose anything on it. I think obviously you can always add disclosures in if you need to, and it may well be that you decide to say, during the year we have advertised on a number of different websites. We consider this to be a marketing expense, and there is a corresponding sort of income from the fact that we advertise our site on other people's pages. However, we are not able to recognise revenue or costs in this manner. Yeah, so I think the kind of voluntary disclosure there would probably be quite a useful thing to do, but there's no formal requirement for disclosure on that.
All right, thank you.